Cease scrolling. Because what occurred Friday wasn't merely a dip, it was a communication, a warning shot. And if you don't comprehend who fired it and why, you're going to misinterpret the next movement. And that next movement is where the genuine currency gets made. Quick heads up, the stats state a huge chunk of you observe every week and still haven't subscribed. If this channel assists you reason clearer in chaotic markets, hit subscribe right now so you don't overlook the next update. Now, let's discuss the punch in the mouth we merely accepted. Gold and silver just printed one of those days that makes your stomach drop. The type of red candle that obtains screenshotted, reposted, and utilized to prove the entire bull run was fake. The type of day where people who've never purchased an ounce in their existence suddenly become experts and inform you, see, I informed you it was a bubble. Here's the aspect they conveniently skip. Even after that smackdown, the month leading into it was still a monster. We're not discussing a slow grind. We're discussing a vertical movement that stacked weeks of gains on top of weeks of gains. That type of run almost always invites a violent reset. Not because the narrative terminates, but because the market needs to shake loose the weak hands, vaporize the overleveraged crowd, and reload. And yes, I've heard the commotion, the accusations, the you ruined people discussion, the you're hiding discussion. So let me be blunt. I'm not hiding, and I'm not here to babysit anyone's emotions. I'm here to inform you what I perceive, why it matters, and what I'm observing next. Because if you're zoomed out even a little, you'll notice something that transforms everything. The trend didn't fracture, it flinched. When a market has been posting higher closes month after month, the most hazardous error you can make is confusing a pause with a peak. People executed that at $40. They executed it at $50. They executed it every step of the way. And then they spent the next leg up informing themselves, I'll purchase back lower, while price never provided them the instance they were awaiting. But I'm not going to sugarcoat it either. We're in a phase where the swings are going to obtain bigger, not smaller. The next wave isn't going to be tidy. It's going to be chaotic. And if you don't prepare for that now, you'll tap out at the worst possible time. Here's what I informed my own viewers weeks ago. When you perceive a relentless run, you have to expect the market to breathe. And when it breathes, it doesn't execute it politely. That's why I've been shifting concentration from the reasonable scenario to the aggressive scenario. In plain English, the conservative targets obtained hit faster than most people reasoned possible, which means the market is informing you it possesses more fuel than the crowd expected. And when that occurs, you update your map. My working baseline now is this. I'm observing for gold to push into territory that compels institutions to rethink their portfolios. And I'm observing for silver to shift into levels that transform industrial users from casual purchasers into desperate purchasers. The first stop on that road can still come with a nasty mid-journey drop. In fact, that drop is precisely what convinces the maximum number of people to quit right before the next surge. And I have to possess something here. Earlier in the week, I discussed a key support zone that appeared sturdy at the time. It maintained during one round of liquidating and then it snapped. That's on me, not because support levels are magic, they're not, but because if you're listening to me, you deserve clarity about the risk, not merely the upside. So let's answer the genuine question. What caused this pullback? I'm calling it what it appeared like. A rescue operation, a bailout. Not the type where someone walks up to a podium and admits it. The type where the plumbing obtains fixed in the shadows and the headlines obtain massaged to make it appear normal. And it initiates with timing, because the liquidating didn't merely occur on a random day. It hit right as the currency narrative was wobbling, right as confidence was initiating to crack, right as people were commencing to question an uncomfortable question. What if the dollar's strength is more fragile than it appears? Then, like clockwork, we obtain a fresh storyline, a leadership transition, a new face being positioned as tough, a suggestion that policy might obtain stricter, that rates might remain higher, that discipline might return. And almost instantly, paper metals obtain slammed in a way that appears less like a natural wave of profit-taking and more like a coordinated attempt to transform the mood. Here's what that type of day executes mechanically. It doesn't punish the long-term stacker who possesses metal outright. It punishes the people who borrowed their position. It hunts leverage. It triggers liquidations. It compels margin calls. It generates a cascade where liquidating generates more liquidating. And the weakest accounts obtain wiped first. And when those accounts obtain wiped, somebody accepts the other side. That somebody isn't your neighbor purchasing a coin. It's the type of player that can absorb size without blinking. So yes, I'm observing the policy narrative, but I'm observing something else even closer. The split between paper and physical. Because here's the cliffhanger. If Friday was the top, physical demand should have died. It didn't. And the next 24 to 72 hours after a shock movement are where you discover what's genuine. Now, in a minute, I'm going to inform you what I heard on the ground from people who actually shift metal for a living. and what they stated doesn't match the panic headlines. But first, you need to comprehend why the bailout framing matters. When a system runs on confidence, confidence is the asset. Lose that, and everything else wobbles. A collapsing currency isn't merely a chart. It's a signal to the world that the guarantees behind that currency are obtaining more difficult to maintain. And when that signal obtains loud, gold isn't a trade anymore. It becomes a vote. So if you perceive the dollar catching a bid while metals obtained smacked, you might reason, okay, problem solved. Not so rapidly. A short-term bounce in the currency can occur for a bunch of reasons that possess nothing to execute with long-term strength. Sometimes it's merely a reset in positioning. Sometimes it's a headline-driven squeeze. Sometimes it's the market purchasing the narrative for a week before the mathematics catches up again. And that mathematics is brutal. Debt rolls over, deficits compound, interest expenses creep, and the instance genuine purchasing power obtains squeezed. Politics pushes policy toward easier currency. That isn't ideology, it's gravity. Based on recently published numbers, the size of government financing needs remains huge, and the market has to digest an enormous amount of issuance. That's not an opinion, that's the environment. And in that environment, hard assets don't need perfection to succeed. They merely need the paper side to maintain executing what paper always executes: multiply. Now let's discuss what I executed next. While everyone was refreshing charts, I sat down with a veteran executive from a major mint at a substantial international coin and bullion gathering in Berlin. No exaggeration, no drama, just straight discussion about what they're perceiving in orders, supply, and conduct. And I initiated with the question you probably desire answered. Is this drop something people should be frightened of? His answer was simple. It's healthy, not fun, not comfortable. Healthy, because when you've possessed an elevator ride higher, you need a staircase step, you need price to backfill, you need time for the market to reconstruct a base, and if you don't obtain that base, the next rally is fragile. He informed me something else that matters. The mood among the serious crowd wasn't panic, it was patience. Consider that. In a room packed with people who exist and breathe this industry, the vibe wasn't "it's over." It was, that was inevitable. Then we discussed the headline of the week, the new central bank leadership narrative, and the idea that policy might suddenly obtain tough. And his take matched mine. The narrative is larger than one person. Even if you swap out a chair, the machine doesn't magically transform. The incentives don't vanish. The fiscal reality doesn't evaporate. Markets can pretend for a while, and that pretending can shift prices. But the underlying pressure doesn't go away. Here's the aspect that made me lean in. He brought up overseas demand dynamics that most retail investors never observe. In certain regions, when metals collapse, purchasers don't run, they lean forward. And those purchasers frequently compensate premiums that inform you the genuine demand hasn't fractured. He stated he'd been observing those premiums, and even during the liquidation, they weren't collapsing the way they would if this were genuinely the termination of the movement. In other words, the dip occurred while some major purchasing centers were offline for the weekend, meaning the market hadn't even heard from everyone yet. So the evident question is, how deep can this go? And he didn't pretend he possessed a crystal ball. He admitted it could go lower. It could require weeks or months to digest. Or it could snap back faster than the crowd expects. But he also stated something that every long-term investor needs tattooed on their brain. If you're constructing a position, you don't execute it by attempting to nail the exact bottom. You execute it by commanding your progression. That's why I maintain hammering the identical tedious advice. Purchase on a schedule and utilize pullbacks as gifts, not as reasons to panic. Now, I'm not going to sit here and inform you to purchase everything. Your situation is your situation. But if you've been awaiting a chance to construct an allocation, these are the instances the market presents, and the instances the market punishes, depending on your mindset. And when I state progression, I mean something painfully simple. 1. Determine what percentage of your savings you desire outside the banking system. Determine the pace you can stick to without strain. 3. Then execute, even when your emotions are screaming at you to execute the opposite. Because Friday exposed a brutal truth. Most people don't lose in markets because they were foolish. They lose because they were rushed. They pursued when the chart was green, then froze when the chart was red. They purchased the pump because they desired the sensation of being correct. And they disregarded the dip because they were frightened of experiencing incorrect. If you've ever executed that, you're not isolated. The market is designed to pull that lever. So here's what I questioned him next. When price is whipping around like this, what should the average person observe so they don't obtain manipulated by commotion? He didn't discuss YouTube thumbnails. He discussed flow. He stated, observe what occurs when the price drops. Does demand disappear or does it shift into the weakness? Because if genuine purchasers step in on down days, That informs you the movement is being supported by something stronger than exaggeration. Then he provided me 3 practical signals he observes in present time. First, delivery windows. When price collapses and delivery times remain stretched, it suggests the pipeline is still busy. Second, wholesale premiums in the major hubs. When those don't collapse, it suggests substantial purchasers are still there. Third, the conduct of secondary supply, meaning people liquidating back into the market. If a drop doesn't unlock a flood of liquidating from old holders, then the everyone's dumping narrative is typically exaggerated. And this is where he stated something I reason is significant for retention, because it flips the fear narrative on its head. A substantial amount of the time, the most frightening candle is the candle that clears the runway for the next rally. That's not a guarantee. It's a pattern. You obtain a relentless climb, then you obtain a liquidation event, then you obtain a base, then you obtain a breakout that shocks the people who swore they'd purchase the dip. So when you question me, is it excessively late? My answer is, it depends on whether you're attempting to be a hero or attempting to be consistent. If you're attempting to be a hero, you'll obtain punished. If you're attempting to be consistent, the market provides you windows like this to construct without pursuing. And that leads to a personal principle I utilize. If I'm ever experiencing urgent, I decelerate. Urgency is typically a trap. Discipline is typically a gift. Now maintain that reasoning, because the next thing we discussed explains why silver specifically can go from composed to chaos faster than almost anything else on the board. And yes, the description possesses bonus links. There's a premium WhatsApp channel link down there and a channel membership join link too. So if you desire the extra stuff, it's sitting there. Now back to silver, because this is where the narrative obtains spicy. Because the silver narrative isn't merely investors obtained excited. It's a supply chain narrative, and supply chains don't transform on a dime. In the last several quarters, demand has been pulled from multiple trajectories simultaneously. You've obtained traditional investors. You've obtained the I desire something genuine crowd. And you've obtained industrial users whose budgets don't care about your chart. They care about continuity. If they can't obtain material, production lines decelerate, contracts obtain overlooked, and competitors accept market share. And then you possess the strategic layer, which almost never obtains discussed openly. Governments don't appreciate to advertise what they're accumulating because advertising it makes it more expensive. But you can infer conduct from policy determinations, procurement language, and how aggressively supply obtains locked up. That's why the conversation about critical inputs matters. When a metal obtains, treated as critical, it doesn't mean there's a warehouse somewhere with a sign that states stockpile. It means agencies and contractors initiate reasoning in years, not weeks. They initiate securing future supply, not merely spot supply. I questioned him. If a government desired to reconstruct a meaningful buffer, what does that even resemble? He stated, it's not a one-time shopping spree, it's a campaign. Consider it. If you attempted to purchase hundreds of millions of ounces in one shot, you detonate the market. So instead, the system executes what it always executes. It utilizes banks and intermediaries to layer bids, negotiate long-term offtake, and quietly accept ownership of future production before it ever hits a public exchange. That's where hedging comes in. When a mining company liquidates forward production, it's not always because they reason price is declining. Frequently, it's because they need financing and stability. But on the other side of that forward sale, there's typically a terminal purchaser. Sometimes it's an industrial user. Sometimes it's a financial institution. Sometimes it's an entity that doesn't desire to be named. And when many of those entities initiate reaching for the identical future supply simultaneously, the squeeze can manifest in unexpected locations. Tighter availability of substantial bars, sudden scrambles for refined product, those persistent premiums I mentioned earlier. He also brought up something most people overlook. Processing capacity is a bottleneck. Ore isn't the identical as refined metal. Concentrate isn't the identical as deliverable bars. If the world recognizes it needs more metal, it still has to shift through genuine facilities, genuine logistics, genuine labor. That requires time, and that's why geopolitical movements around resource regions matter. Even if you reason you don't care about politics, command over mines, smelters, ports, and permitting is command over future supply. You can perceive it in the way substantial powers court certain countries, invest in certain processing projects, and pressure trade relationships. So when you hear chatter about a new smelting project or a new refining expansion or a new push to secure production in the Western Hemisphere, don't treat it like trivia. Treat it like a signpost. Because if the system is spending genuine currency to expand the pipe, that informs you they believe the pipe will be needed. And that's the distinction between a meme movement and a structural movement. Last year, the identical mint executive informed me something that people laughed at. that the setup for a genuine shortage was constructing. Not the fake, there's a shortage because my local shop is out of one specific product type. The genuine type, where demand for the raw material collides with constrained supply chains. And when silver initiated ripping, the mainstream didn't understand what to execute with it. So they executed what they always execute. They called it a bubble. But the bubble narrative doesn't explain the conduct of industrial demand. And it definitely doesn't explain the conduct of governments. Because here's the twist. In the last few years, silver has been increasingly treated like a strategic input, not merely a shiny commodity. And when a metal becomes strategic, the purchaser transforms. It's not merely investors pursuing price, it's entities securing supply. That's a different game. And it connects to something larger that most people don't desire to discuss. The world is deglobalizing. Supply chains are being pulled apart and reconstructed along political lines. Trade isn't merely trade anymore, it's leverage. And in that environment, countries desire command over inputs that power defense, technology, energy, and manufacturing. Silver sits right in the middle of that. It manifests in electronics. It manifests in high-performance applications. It manifests in energy systems. It manifests in the stuff nobody desires to run short on when tensions elevate. Now I'm going to challenge one aspect of the popular narrative here because I reason it's lazy. A substantial amount of people state there isn't enough silver, period. That's catchy, but it's not precise. The genuine issue isn't that silver vanished from the planet. The issue is that the available deliverable silver, at a price the market is utilized to, can obtain tight rapidly, especially when multiple substantial purchasers determine they desire it simultaneously. That's the auction problem. One bidder, price remains composed. 10 bidders with deep pockets, the clearing price jumps, even if the item technically exists. And from recent market updates, you can perceive hints of this in how quickly certain forms of supply obtain soaked up after pullbacks. Price drops and metal still shifts. Then we discussed refining and bottlenecks. People hear refineries are backed up and assume it means there's excessively much supply. That's backwards. Backed up frequently means they're booked. It means they're committed. It means substantial contracts are already spoken for, and smaller purchasers obtain push to the back of the line. And that generates an illusion. Retail experiences out of stock, while substantial players quietly maintain receiving bars on schedule. Here's a simple way to picture it. Metal obtains liquidated at the retail level. It obtains aggregated. It obtains transmitted to refiners. And a portion of it terminates up in substantial bars that feed the institutional pipeline. If that pipeline is humming, the bottleneck doesn't mean the party is over. It means the party is crowded. Now the executive also pointed out something else. This isn't merely existing holders liquidating to new purchasers. It's new purchasers entering because the world experience is less stable. People wake up to the idea that cash isn't a guarantee, and they initiate diversifying. And when that occurs globally, it doesn't require a huge percentage of the population to transform the market. A small shift in allocation can be enormous when the market is relatively small compared to the size of global prosperity. That's why silver can appear sleepy for years, then appear insane in a few months. Now let's switch to gold, because gold is a different animal. Silver can act like an industrial commodity with a wild, speculative tail. Gold is the thermometer for trust, and right now, trust is cracking. Not because one country is evil or one leader is incorrect, because the entire system is under strain. Every major currency is combating the identical combat. How do you fund guarantees that are larger than your tax base without crushing your population? And the politically easy answer is always the identical. Let inflation execute some of the labor. That's why you're perceiving central banks conduct themselves the way they are. They're not trading, they're reallocating. They're admitting quietly that holding excessively much of any one paper guarantee is a risk. According to the latest publicly available filings, a growing list of countries have been increasing their gold share over time, and some have been far more aggressive than others. You've perceived European countries ramping. You've perceived emerging markets executing it. And you've perceived a few surprising players accelerate because they desire more independence. One country in particular has been constructing its position aggressively. And the reason isn't mysterious. If you desire more influence, you need more resilience. And gold is resilience. Now, because we were sitting in Europe, we couldn't avoid discussing the energy problem. Industrial competitiveness depends on stable, affordable energy. When energy obtains expensive or unreliable, manufacturing migrates, investment shifts, politics heats up, and the pressure on currency policy increases. Because governments attempt to soften the blow. That's not a theory. That's how economies function. So when you connect rising gold demand with shaky energy dynamics, you initiate to comprehend why gold's movement isn't merely a chart sequence. It's a map of strain. Then I questioned him the question everyone questions when prices are flying. Are we late? And I desire you to listen to this carefully. He stated, we're not at the termination. We're closer to the termination of the first act and the beginning of the second. Translation. The narrative has progressed, but the climax hasn't hit. He utilized a sports analogy, the idea that we're not in the last inning yet. There's time left. There are twists left. There are policy shocks and geopolitical surprises left. And those surprises will be the instances that either fracture people or make them. So what does that mean for you? It means you need a time horizon. You need emotional stamina. And you need a plan that doesn't depend on being correct every day. Because here's the truth nobody appreciates. The market will embarrass you on the way to compensating you. It'll drop on the day you experience smartest. It'll spike on the day you experience most hopeless. It'll tempt you to pursue, then punish you for pursuing. And it'll reward you if you can remain rational while everyone else is acting like it's the termination of the world. Now, I'm going to add some fresh context that matters, because excessively many people discuss metals like they exist in a vacuum. Let's discuss real rates. When inflation runs hotter than the interest you earn, you're losing purchasing power, even if your account balance is flat. That environment is gasoline for hard assets, because investors initiate examining something that can maintain up. Historically, periods of negative genuine rates have lined up with robust runs in commodities. Not because commodities are magical, but because the currency unit is deteriorating relative to genuine goods. Now combine that with the portfolio mathematics problem. Substantial funds and institutions have traditionally been anchored in a mix of stocks and bonds. But if bonds cease conducting themselves like a safe ballast, if they initiate losing purchasing power while also losing price, then the classic playbook obtains rewritten. And when the playbook obtains rewritten, new allocations obtain considered. Gold is frequently the first stop in that conversation because it's liquid and universally recognized. But it doesn't terminate there. Once the door opens, currency initiates examining the broader hard asset complex: energy, materials, select producers, and yes, dividend compensators. And this is where I'll state something that might surprise you. Even if you're not bullish on oil headlines, energy assets can still be compelling because they serve as a hedge against the identical inflation dynamics that push metals higher. The competitor crowd loves to pretend you have to select one team. You don't. You can possess hedges that cover different aspects of the identical storm. Now, before I go further, I desire to execute this once because it matters to community. If you're successful, share your achievement narrative in the comments so others can remain motivated. People need to hear that it's possible to remain disciplined. All right, back to the plot. If Friday's movement was a bailout, then the substantial question is, who obtained rescued? First, the most evident victims were leveraged traders, the ones who treated metals like a meme coin, loaded up on margin, and assumed the chart only elevates. That crowd obtained cleaned out. Second, the paper market makers who were exposed to rising prices obtained breathing room. When price collapses rapidly, paper obligations become easier to manage. Spreads widen. Panic assists. Third, the currency narrative obtained a temporary makeover. A shiny new, responsible storyline obtained to accept center stage. But here's the cliffhanger. None of that fixes the underlying driver. Because the underlying driver isn't sentiment, it's arithmetic. And arithmetic doesn't care how confident a talking head sounds. So what am I observing next? I'm observing the rebound attempts. The first attempt is typically weak. It fails, it shakes people again. Then you obtain the genuine pivot, and the genuine pivot frequently comes when the crowd has emotionally surrendered. I'm also observing physical premiums and delivery times, not because I care about one product being out of stock, but because the trend in tightness informs you whether demand is actually retreating or merely accepting a breath. And I'm observing policy messaging, not the speeches, the incentives, because the second act of this bull cycle won't be driven by a cheerleading rally. It'll be driven by an instance when the market recognizes the guaranteed discipline can't last. Now, this is the aspect where a substantial amount of you desire me to draw a direct line to a price target. I'm not going to execute that. What I will execute is inform you the framework I'm utilizing. Gold tends to shift in waves tied to trust and liquidity. When trust cracks, gold elevates. When liquidity obtains squeeze difficult, gold can dip. Not because the narrative is incorrect, but because everything obtains liquidated to raise cash. Then, gold comes back, frequently stronger. Silver tends to exaggerate whatever gold is executing, with extra volatility layered on top, because of its smaller market and industrial component. So if you're constructing a position, you should assume the path is jagged. Now let's discuss the members-only side for a second, and I'll maintain it tight. We execute possess members-only videos produced by a separate team that goes deeper with more research and more supporting context. Those are only for premium members, and they're constructed for people who desire the extra layer without the commotion. All right, back to the interview, because he terminated with something that stuck with me. He stated, "Cease treating this like a day trade. Treat it like a journey." That's not motivational fluff, it's survival advice. because the metal isn't merely a ticker. It's a form of insurance against policy failure, against currency dilution, against the type of solutions that appear favorable on a press release but quietly erode your purchasing power. So, if you're young, it's a long runway hedge. If you're older, it's a stability tool. If you're constructing a family, it's a way to diversify the type of risk you can't diversify with paper isolated. And yes, some people will accept profits. That's normal. Maybe they compensate off debt, maybe they fund school, maybe they purchase a home. There's nothing incorrect with that. But the market doesn't terminate because someone liquidates. The asset merely shifts into a new set of hands, and frequently into hands that need it for a different reason. Now let me question you a question, and I desire you to actually answer it in the comments. Do you reason Friday was a healthy reset? Or do you reason it was a warning that something larger is fracturing behind the scenes? Because your answer informs me where your head is, and it informs other viewers they're not isolated. And here's the second question. If you've been stacking or investing through this run, what's your plan when the next violent pullback hits? Are you adding, holding, or bailing? Drop it below. And while we're on community, I'm going to state it again later, but I'll state it now too. If you're successful, share your achievement narrative in the comments so others can remain motivated. Now let's land the plane with what I reason is the most significant takeaway. Friday didn't prove metals are dead. Friday proved the combat is genuine. When prices elevate in a way that threatens narratives, narratives obtain reconstructed. When prices elevate in a way that stresses balance sheets, the market discovers a way to release pressure. That's not conspiracy. That's how systems conduct themselves. So I'm not here to inform you everything is fine. I'm here to inform you the game has entered a higher volatility chapter. If you can handle that, you'll be positioned when the next leg discloses itself. Because the next leg isn't going to announce itself politely. It's going to manifest after everyone ceases observing. So if you desire to remain plugged in, check the description for the bonus links I mentioned earlier, and make sure you're subscribed. And as always, accept care of yourself, accept care of your people. And don't permit a single brutal day convince you the long-term mathematics disappeared. That's the whole point. One last thing before you go. Nothing in this video is personal financial advice. I'm sharing my analysis and my framework for learning and discussion. You're responsible for your own determinations, your own risk, and your own research. And if you need a professional, discuss to a qualified one who understands your situation.